want to welcome you all to our first time home buyers class. I'm here with Keressa Jenson from Prime Lending. Okay, we're going to go ahead and get started.
Okay.
So, first time homeowners, things you need to know.
Okay, so here's what we'll cover today. First, you're going to contact your lender. We'll get you pre-qualified for a purchase price. We'll talk a little bit about credit and how that is going to affect your loan, and then we'll talk about some different loan programs, and then Cherie will take it from there.
Then you contact me, and we're going to go and visit some homes, and then we're going to close and get you some keys.
Awesome. Okay, so here's my contact information. It's also in your packets, but you can take a picture, add it to your phone, whatever you want to do. It's my work email and my cell phone number. I don't keep banker's hours, so a lot of people are confused by that. You can call or text me anytime. Okay. There's a few things that go into your pre-qualification. We look at your credit score, and your credit history. And then another very important piece is your income. You have to have some kind of income in order to get a loan. And then we go into your debt to income ratio. We have to keep your debt to income ratio. It's exactly what it sounds like. Your monthly debt compared to your monthly gross income. We have to keep that around 50%. And then your liabilities are also factored in, which are your monthly debt, how that affects your debt to income ratio. So I guess we'll start at the top. For credit, for an FHA loan, we can get you as low as 580 credit score, which is a lot lower than most people think. And then we can go upwards of that. Obviously, the higher your credit, the different loan programs that you'll qualify for. For your income, the easiest income to qualify is obviously just traditional W-2, nothing crazy income. But we can also get you a home if you're self-employed or contracted. It's a lot easier than you think. There's a loan program that we can even average out your income over 2 years. So if you've recently started into sales and you're making way more money than you ever have before, we can average it over 2 years, even if you haven't been working there for 2 years. So because we sell directly to Fannie Mae and Freddie Mac, they give us a little bit more flexibility. We don't have any overlays from like our lending company. Your debt to income ratio, again, we just go up to federal limits. So usually about 50%, depending on credit score, maybe as low as 45, but that's something that we'll talk about individually. And then your liabilities are just try and keep them low, because it's a lot harder to qualify if you have high monthly payments. Okay, so if somebody were to come to me and tell me, hey, my credit is really low, I don't know if I'll be able to qualify, we have a lot of just derogatories on my credit history, the first thing that I tell people to do is to work on those discrepancies. Typically, you can create an account with the credit bureaus and dispute anything, any discrepancies on your credit. So that'll usually boost you a couple points. The second thing that I tell people about is your credit usage on any revolving credit line that you have. So a credit card, a home equity line, anything revolving, anything that you can take money out and then pay it back, and then, you know, that revolving credit. So anything with that, you want to keep your usage, so how much you've used, at 22%. That's like the magic number, is 22%. That's where it starts building and stops dinging you. But definitely keep it under 100%. I've seen several people that have it over, like it'll be like 106% usage, And then as soon as we drop it down under 100, their score bumps like 20, 30 points or whatever. So definitely keep it under 100. If you can, keep it right around that 22%. Another thing that'll hit your credit pretty hard is recent trade lines opened. So that does not mean, oh, I already got pre-approved with this lender, I want to get a quote from this lender too. You are legally allowed to shop around for lenders. You have to. So if you get a quote from 10 different lenders, that's not going to hit your credit. It can't. That's when we had some mortgage fraudy 2008 type of stuff. You can shop lenders, but on the flip side of that, if you're going within 30 days and opening a credit card, a car loan, applying for a mortgage, pulling out a home equity line from your current home, all of these different things within like a very short amount of time, that is going to hit your credit very hard. So if you know within a month or two, I want to go buy a home, try not to apply for anything. Even the like 20% off store card, don't, just hold back, self-restraint. Don't apply for that. Once we pull your credit to get you approved for a loan, that's when you know you're going to be buying a home within the next couple of months. You're pre-approved or pre-qualified, you're ready to go. You will be on active credit monitoring. That means anytime your credit is pulled, we will get notified that you have a new credit line opening. So, so be very careful about that. We don't want to have anything popping up on credit that will, especially if we're really close on that debt to income ratio, we don't want to have anything that'll bump you over. So once we pull your credit to get you pre-qualified, do not open any trade lines. If anything happens on your credit, you need to call me first. I will be your very best friend. If you think, hey, I think I want to get a new car, call your lender. Let's talk about it. Let's see what your payment's going to be. Let's discuss that before you go and do anything. Or even, hey, I think I'm going to pay off this car. Call me first. Because maybe we were planning on using those reserves that you're going to use to pay off that car. Anything that has to do with your credit can affect your loan. So make sure you call me first.
Even if you have a line of credit, a Sears card or whatever, and you go and purchase a new dress on it, even if it's $25, you need to talk to Keressa first before doing that, because that can put you over your line.
Yeah, we just want you to keep everything the same as it has been for whatever. Like, don't make any crazy changes. Keep everything pretty normal, pretty standard. Okay. We are going to go ahead and leave out the VA loan because I don't think that applies to anybody here. So we're going to talk about our different loan programs that we have available. These are the most common loans that we put people in. At Prime, we have over 400 loan programs. So we're narrowing it down quite a bit. So the probably most common loan program nationwide is a conventional loan. That's the Fannie Mae, Freddie Mac. Those are government entities that regulate mortgages. They have the best loan terms if your credit score is over like a 720-ish range. So if you're over that, they're like 3 to 5% down. You're going to have the best interest rates, best mortgage insurance, if you fit into that category. The next one, let's talk about a jumbo loan. Each county has a different conforming loan limit. So just really quick, in Salt Lake County, if you're over 600,000, I think it's 600,300, they change it every so often, then you're going to be in a jumbo product. The loan terms are just a little bit different, not necessarily better or worse, just a little bit different. In Utah County, it's around 415,000. I don't know exactly off the top of my head because they're different in every county. So that's a jumbo. It's just over if you're over a conforming limit. Okay, USDA and FHA, those are government programs. USDA has to be in a rural development area. So that's based on geographical limits. So you're looking closer to like Saratoga Springs or Tooele, just somewhere out of town. If you want to do a USDA loan, you come talk to me, obviously, and we'll talk about where you can look to qualify for a USDA loan. This is a zero down program, so it's really attractive to a lot of buyers if you don't mind being maybe an extra 10, 15, 20 minutes outside of town. So that's a really good option if you're looking zero down. An FHA loan that's like, we can go as low as that 580. So if you have a little bit lower credit, an FHA loan is probably going to be more advantageous to you because they give you a break on your interest rate, and they also give you a break on mortgage insurance. So they have a standard mortgage insurance. Whether you are a 580 or an 800, you're going to be paying 0.85 for mortgage insurance, 0.85% of your loan amount for mortgage insurance. Doesn't matter what your credit score is. So if you're a little bit on the lower side, then an FHA loan is probably going to be the most advantageous for you. And that's a 3.5% down. Typically you can go above that, but usually around 3.5%, that's where you'd go for an FHA loan. And then Utah Housing, this is our big one for zero down programs. How this works is there's only one product that's a conventional loan in Utah Housing. They give us 4 different options. And like the 3.5% that you would pay down for an FHA loan, most of them are FHA, so we're going to go with that. You basically just take out a second mortgage for that one. So you'll have a split mortgage, one that has a lower interest rate, that's your bulk loan, and then one that has a little bit higher interest rate, and that'll be just the down payment closing cost portion. That's our most common zero down program. And you can go as low as 620 for a zero down Utah Housing loan. So a lot of really good options. Within all of these, there's a few different programs, and again, there's 400 plus loan programs, so there is something for everyone.
We should be able to find one for you.
Yes. Okay. I'm just going to answer these questions just for sake of time. So there's a huge misconception that closing costs are the seller's responsibility. So I want to bust that myth right now. Closing costs on the buyer's side are the buyer's responsibility. The sellers of this same house that you're buying, they have their own set of closing costs that they have to pay. So your closing costs are your responsibility. We can talk to your realtor if you don't have the extra money to pay the closing costs. We can talk to the realtor and say, hey, we want to offer a little bit more and get a seller credit to pay our closing costs. That's absolutely doable, but it's not their responsibility out of the gate. It's yours. It's 100% your benefit.
It used to be that a lot of times the seller would cover the buyer's closing costs, and that is no longer what happens because the closing costs are split, buyers, sellers. So we like Keressa said, we can ask for a higher price and ask them to cover those closing costs, so it's actually tied into your loan.
Yeah,
so,
it just gives you the option to finance them, basically,
right,
rather than coming to closing with cash to cover them.
As long as we do not go over what she qualifies you for.
Yes, yeah.
Or the appraised value of the home.
So you have to be careful with that, but we can work with it. Okay, the reason that they are your responsibility is because of what they cover. So the biggest bulk of your closing costs is going to be your escrow setup. Your escrow setup, in case you don't know what an escrow account is it covers your, I just blinked, taxes, property taxes and homeowners insurance. So your homeowners insurance and property taxes get paid out yearly. So I don't know about you, but I don't want to come up with a couple grand once a year. So instead, I'd rather pay a little bit interest-free into an account that can hold it for me. There's no extra like yearly fees. It doesn't cost you like extra. That's just how we set them all up. So I'd rather pay a little bit extra monthly. They hold it in an account for you, and then they pay them out directly every year.
That does fluctuate some years to the next year. So sometimes they may have abundance in there, and sometimes they may have to take a little more, so your house payment will kind of vary, but usually not very much.
No, they usually keep a buffer, but they can't keep more than a 2-month buffer. So they try and mitigate that, like inflation and property taxes, but if you pay over, if you're like your homeowner's insurance drops significantly, then they'll give you a refund. So they regulate that a little bit so that it doesn't throw your monthly payment.
And if I can butt in again right here, you need to call different homeowners insurance companies because they can fluctuate a lot. So my son was buying a home, and he called somebody that somebody had recommended, and the payments were like $1,200 a month for a year, and that was way over, and I knew it was, so I had him call some other places, and he got it down to where it was $500 for a year. So that's a big difference, and that dropped his loan payment by about $200. So.
And that affects your debt to income ratio as well, because we're looking at your total monthly payment, which will include your monthly homeowner's insurance payment. So if your monthly homeowner's insurance payment is double or triple what the regular amount is, you're not going to be able to qualify for as much money, because that's going to take up a lot more of your monthly payment. So definitely shop around. I keep just kind of a record of who's the cheaper rates that I get. Like if I'm like, oh, that one's really low, then I'll grab that insurance agent's contact info. So I usually give out 2 or 3 to my clients that I say, hey, these people are really low, so definitely call them. You don't have to use them. You can use whoever you want, but give them a shot, get a quote, because you can use that quote to shop around.
Right. So
your biggest bulk is going to be your escrow setup. Another huge part of your closing costs is going to be your title insurance policy. So your title insurance policy covers any liens on the property. So if you were you bought a house, right? You're living in it, you're so happy with this new house for 6 months or whatever, and then somebody comes and forecloses on your home because 2 or 3 homeowners back, there was a second mortgage taken out on the house that never got paid off, they still have a lien on your property that you now own, and they can foreclose on it. So title insurance mitigates that risk. Just like health insurance or automobile insurance, they make sure that you can't get foreclosed on because of a lien that you didn't take out, basically.
Right.
And that's even, you can get a lien on new builds, there can be a lien on contractors, there can be a lien on land. So even on a new build, you still need title insurance. And then closing costs are paid at the closing table. So if you did not receive a seller credit to pay your closing costs, they are due when we sign your closing documents. They will give you, you wire instructions at closing to pay your closing costs, your down payment.
And in your packet of papers, there is a wire fraud paper here. I want you to read over this, because once they tell you how to wire that money that you're paying your closing costs, that will never change. And if you get an email, a phone call, your first call should be Keressa. or me. If you can't get Keressa, you've got to call me.
Okay, and don't let anyone scare you into wiring money right now. This happens a lot more often than we would like. And so you may get a phone call saying, hey, you need to wire money right now or it'll delay your closing. You won't be able to close on your home. Do not, under any circumstances, wire money. The title rep that I use most often, she's very good. Her name's Brooke. She works at Vanguard Title. She's amazing. She will hand you a document at closing that says, here are your wire instructions. Only follow these wire instructions. Do not follow any wire instructions that were emailed to you, given to you in the mail, phone call, whatever. It'll be a physical document that she puts in your hands directly. Those are the only wire instructions that you are to follow. So if you get an email or something with wire instructions, do not wire money. No. She will never just send you an email and say, here, follow these wire instructions. The only reason that she would email them to you is if you called me or her or Cherie and asked specifically for the wire instructions to be emailed to you.
Right.
That is the only time. And she will not threaten, she will not, like, she's very sweet, she's very sweet. She will not threaten you or tell you you're gonna delay, whatever. You don't wire money until after you sign. You will meet her in person before you wire money to her.
Yes.
So. And if you want to write a check, you can do that too. We'll talk about that a little bit later.
Right, okay.
Okay. Anybody have questions?
I think we pretty much covered most of it, so.
Okay. Okay, Cherie.
Okay, so I am your real estate agent. My contact information's here, or again on the packet. Next slide, please. Different job. Okay, so I have the fun part of the job. We get to go and visit homes. So, but before we do that, I need you guys to determine what type of home you want. Do you want a big backyard? Do you have kids? Are you planning on having kids? Do you want an alley? Or do you not want an alley? Do you want a basement, big kitchen, little kitchen, bigger dining room, bigger family room? How many beds? How many baths? Do you want a garage? Do you need a 2-car or 3-car garage? But most importantly, when we go out and look at homes, there will be a feeling when you walk in the homes. You will automatically decide, I don't like this house, something about it, something the way it feels, or you will fall madly in love with it. That's just how my experience has been. People find the home that they want, and then, next slide please, we get to make an offer. Now there's some things when we make an offer. We need to write up a good offer, an offer that the seller is not going to be offended by. So if we're looking at a $300,000 home, that's what it's listed at, and you come in at $200,000, you're going to offend that seller, and that seller is not going to want to work with us. We will look at the home, we will talk about it. You guys will probably ask me my opinion. I can give you the facts, so I can do a comparable market analysis on that home. We can decide how much you want to offer. If you absolutely love that home, then we may go ahead and offer $310,000. If we need to pay closing costs and you can qualify up to $350,000, we may want to go $320,000, $315,000. Cover closing costs. That means you don't pay as much at the closing tables. So we also have to think about earnest money. Earnest money is money you pay the seller to make an offer on that home. You pay the earnest money
just to let them know you're serious about it.
So that you're serious, that you really want that home. I usually have a rule of thumb that for anything under $100,000, it's $100. $100,000 to $200,000 is usually $1,000. No, back up. Anything $100,000 or less is $1,000. How much is it? How much? flip that out, can we? Usually it's $1,000 per whatever you want. If you're going for a 200, 300, it's usually 200,000 or 1,500. So I try and make it so it's kind of even on what we're offering.
Under 100,000, like $500?
$500, yeah.
And then 100,000 to 200,000, like $1,000.
$1,000, yeah. So that's kind of what I do. That was kind of a hard explanation. Sorry. If you have any questions, talk to me afterwards. Third of all, I want you to get an inspection on that home. The inspector's responsibility is to find any and everything wrong with that house. Whether it's the concrete's buckled, or if you've got a plug that doesn't work, if you've got lights that are falling out of the ceiling, if you've got insulation issues, if your oven's not working, if the dishwasher's not working, you need to know. So that's why we hire an inspector, is to go out there and thoroughly go through the home, find any and everything wrong with the home so that you know what you're buying. And it goes back to the FHA and VA. If there's something wrong with that home, peeling paint, then
It won't comply with FHA guidelines.
right, so we need to know that in advance so that we can take care of that. So, did you have a question?
Yeah, who hires the inspector?
Good question. You do. You hire the inspector. I will give you recommendations for 3, but you need to call and you need to set it up. We will work closely together and get that, or if I have your permission, then I can hire the inspector, but there again, you have to pick it. You have to choose who's coming out to inspect your home.
But don't get scared by the length of the inspection. Sometimes you'll have a brand new, beautiful home, they'll send you a 10-page inspection because they say, oh, well, there's a crack in the concrete, or, you know, little things that may not be that important to you.
Right. And bringing up a brand new home, get an inspection on that too. There was,
Who pays for the inspection?
who pays
The client
for
will pay for the
the
inspection.
client will pay for the inspection. I was going to think of something. Oh, there was a home, brand new home. They didn't have an inspection because they didn't think they needed it, and they moved in, and all of a sudden they were draining their bathtub after giving their kids a bath, and they were like, what is that noise? Come to find out, they had not hooked the drain pipe up under the home. So it was draining out under their home. And if they would have gotten a home inspection, that would have been fixed before ever moving in. And now it's your responsibility to have that hooked up. So great idea to have an inspection. So after the inspection comes back, you look at it, you go over it with me. I will get a copy of that inspection and we will go through it. I would like you to pick the top hazards or things that you can't
Live without.
live with or without, okay? So it may be something simple. Maybe there's a hole in the sheetrock upstairs or something, and you can fix that. Great, but Bob may not be able to fix it. So that may be a big concern to him, or it's a GFI that needs to be replaced or put in or something like that. Those are things that we need to work together, and we will go back to the seller and either ask for a bulk money off of the sales price, or we'll ask him to fix those. So that's important to know that we can do that because we have this time period. But when we submit an offer, we have only a certain amount of time to get all of this done. So we need to know what inspector you want to use so that we can get them called, get them out, get it inspected, get the report back. Usually it's 2 to 3 days for them to go out to the home, and usually a day or 2 for them to get the report back to you. So we need that time so that we can go through that report together. Next slide. Okay, fun with forms. You guys have a packet. Mine is not stapled. This is just some forms that I have put together that you will see when we make an offer, when we're working together. Some of these, this is just the contract. Then we have deposit of earnest money. Very important, you have 2 days to get your deposit of the earnest money to the title company. So we need to make sure that that's ready to go when the offer is accepted. Disclosure and knowledge of lead-based paint. Anything over 1978, anything prior to 1978, 78 or earlier, you will have lead-based paint. That's just how it is. There's no home that was built prior to 1978 that does not have it. It's covered up.
Completely gutted.
But even at that, there's going to be traces.
Yeah.
You need to know that in case you have small children, in case you have a pet that chews on the paint, or if you're looking at a home and you think, you know, I really don't like how that wall is between the kitchen and dining room, I'm going to rip that out. You need to know because you need to wear protective gear because that lead-based paint is very toxic. So just something to keep in mind. Now, this form here, the seller's disclosure statement, is very important. The seller has went through this and has answered yes or no on all of these questions, such as, has there been cosmetic upgrades to the house? Is there any problem with the electricity? How's the fireplace? How's the appliances? How's the exterior? How's the roof? How's the plumbing? Whatever. You're supposed to answer these truthfully, and I'm not saying that sellers lie, but sometimes if they don't know, they're going to mark they don't know or no. We have a responsibility on this paper that's called buyer's due diligence. This is very important for each of you guys to look over because when you buy a home and you move in, whether we've had an inspection or not, which I won't sell a home that they don't have an inspection on, so I hope you guys all get one. You have the responsibility of knowing if your neighbor throws a party at 12 o'clock on Saturday or Friday night. You have a responsibility to know if there's a ball game that goes on in the summer two blocks down that keeps everybody up until midnight. You need to know what you're buying. So we will read over this because this is very important. It's not my responsibility. I can help and guide and direct you. As far as a neighborhood, I can tell you nothing. One neighborhood is just the same as another to me because it is illegal for me to say, this is where you need to live and this is where you need to live. You have to make that choice. You have to determine if that neighborhood's safe or unsafe. So
drive the neighborhood, check out the school districts, take a walk through the neighborhood, check it out. Take your time and make sure that'll work for your family.
If you're looking at homes, go out and drive around. Go to open homes. Just know that I'm your agent and that I'm there for you. And I will do my best. I will look up school scores. There's things that I can do to give you information so that you can make the best choice.
We'll throw all the information at you, but you have to make the decision.
Correct. Yeah, we're here to help and support you. But this is your home, and we want you to be in a home that you absolutely love for the next 10 years. And that fits your family and that you can afford. And it's not going to weigh you down. Yeah. Okay. This slide is kind of fun because we talk about reviewing and signed documents. Record, which is very tricky. when you're closing a home, and then when you get your keys. So we're going to give it back to Keressa, and she's going to go over the top two.
Okay.
Or one.
Yes. Okay, so when is your closing day? First thing we're going to do, well, there's a lot that happens on the back end. I'm going to send all of my closing documents, everything that I've prepared over the last month. It usually takes about 30 days to close a loan. I'm going to send all of that to our title rep, and she is going to look over them. She's going to print them all out, and then she's going to meet with you. We try and do most of our closings in the morning. If that doesn't work for you, we can push it later. Our title rep can go to you if it's easier to meet at your work. Wherever you decide to sign your documents, we'll make that happen. So you're going to sign all of your documents, and then you're going to leave and go home or to work or wherever you're going to go that day. And then the title rep is going to send all of those documents back to me or to my company. We're going to review all the documents, then we're going to send our wire to the title company. And then you are going to go to the bank and send your wire to the title company. Once the title company has both of our wires
And all of their money.
and all of their, everybody's money, then they're going to fund the loan. They're going to release it to the sellers or the lien holder of the property, which is usually the bank, because most people don't own their homes outright. So they'll pay off the bank, send whatever's left to the sellers. And then at that point, when everything's funded, then the title company will reach out to the county and record your name on title. And once it records,
Then
it's you.
you own the property. I usually put it that you, on the day that it records, that you can get in by 5 o'clock. You cannot move anything into the home before you get the phone call from me that it's recorded. We're not even going to ask to move in a week early because your lease is up on your apartment or your buyers are moving into your house. You're going to have someplace to go. We need to talk about the dates to make sure that you don't move in before it records, because the house still belongs to the seller. It does not belong to you until it's recorded at the city offices.
So even if you take one shoebox and put it in the garage, you are taking ownership of the property before it is yours. That's a breach of contract. You can lose the house. So we do not move in until it is recorded with the county.
Okay, so I get the phone call, it's recorded at the county. I have possession of your keys, so then I will get with you and I will give those keys to you and congratulate you on buying your first home. So that's kind of how it is. Next slide. Came down to questions. So does anybody have any questions? I appreciate your question during the thing, because it's sometimes easier to answer then, so.